Two companies, same profit, 1 million zloty, same owner, same year. One of them hands over roughly 260,000 zloty in tax before the owner sees a penny. The other hands only 200,000 zloty, and if the owner decides to leave the money in the business instead of taking it out, the second company pays no corporate income tax at all in that year. Same profit, two completely different outcomes. And the difference is which corporate income tax model the company uses. Today I'm breaking down how the classical corporate income taxation in Poland works, as well as how the corporate income taxation within the so-called Estonian corporate income tax, or also known as lump sum corporate income taxation, in Poland looks like, side by side, so you can see where the gap comes from and whether it applies to you. Hi, my name is Michał. I'm a Polish licensed tax advisor, and I provide accounting, cost calculation, tax compliance, and tax advisory services for small and medium-sized enterprises in Poland. I am going to walk you through how the classical corporate income tax system taxes your company, how the so-called Estonian corporate income tax taxes this company differently, and where the real advantages are. Then I will cover who actually qualifies for the taxation within the so-called Estonian corporate income tax model, because it's not automatic. And I will also show you what might be the two key advantages of using the so-called Estonian corporate income tax model. Let's start with the classical corporate income tax settlement, which is the system most Polish companies still use, because Estonian corporate income tax only makes sense once you see what it's replacing. Under classical corporate income tax, your company pays corporate income tax every single year. It settles the corporate income tax every single year, but pays this corporate income tax on a monthly or quarterly basis as corporate income tax advance payments. If your company is a smaller taxable person, namely the taxable yearly revenue of this company does not exceed the amount of 2 million euros, then this company pays 9% of corporate income tax. And all other companies, the bigger companies, the companies whose turnover exceeds 2 million euros in a year, then these companies pay 19% corporate income tax. And that's the step one of the taxation. Step two happens when you actually pay yourself a dividend, and then at the moment the profit leaves the company and lands in your personal account, it's taxed again. A flat 19% personal income tax on dividends with zero offset for the corporate tax you already paid. So the same zloty gets taxed twice, once at the level of the company with the corporate income tax, and then the second time at the level of the owner while he is distributing this profit from the company to him with the personal income tax at the level of 19%. And that's the double taxation the classical corporate income tax, not only in Poland, is known for. And, which is also important, the first layer of tax, namely the corporate income tax, is due every year regardless of whether you are distributing the profit or not. Even if you reinvest every penny back into the business, namely you are not distributing the profit as a dividend to you at all, you still have to pay corporate income tax, which is settled for a year within a corporate income tax yearly declaration, but is payable on a monthly or quarterly basis as corporate income tax advance payment. And consequently, within this classic corporate income tax settlement model, you are effectively landing on a tax burden of 26.29% if your company is a smaller company paying corporate income tax at the level of 9%, or you are landing at the effectively, namely corporate income tax and personal income tax combined, you are landing on 34.39% if your company is a bigger taxable person to which 19% corporate income tax applies. And within the Estonian lump sum corporate income tax settlement, your company doesn't pay the corporate income tax on profit as it's earned. In such case, the Estonian corporate income tax flips that classical corporate income tax settlement structure. Under this model, your company pays this corporate income tax only when that profit is actually distributed to the shareholders, typically as a dividend. So if you leave the profit inside the company to fund growth, hire, buy equipment, build up cash reserves, you pay no corporate income tax on it for as long as the profit stays in the business. That's the headline advantage. And for a company that's reinvesting rather than paying out, it's enormous. Every zloty that would have gone to the tax office instead keeps compounding inside your business. The corporate income tax only enters the picture the year you actually distribute the profit. At that point, the company pays the lump sum corporate income tax at the rate of 10% if it is a smaller company with a yearly revenue of up to 2 million euros, or it pays 20% if it is a bigger company. But also please notice that these 10 or 20%, they will be only applicable on the amount of dividend paid out of the company, not on the whole profit earned in the year the profit was distributed, but only on the amount of profit that was actually distributed to the shareholder. So the profit that is left in the company is still not subject to corporate income tax within the Estonian, or also known as lump sum corporate income tax settlement. And here's the part that makes the Estonian corporate income tax different. Namely, when you as the shareholder pay your 19% personal income tax on the dividend you received, you are allowed to deduct a large chunk of the corporate income tax your company already paid. Classical corporate income tax settlement does not give you such offset. And consequently, you come up on a effective tax burden of the dividend, namely corporate income tax and personal income tax combined, of 20% if for your company the applicable corporate income tax rate are those 10%, or 25% if for your company the applicable corporate income tax rate is 20%. Please also note that this example is valid only for cases where the owner is a person which is a Polish tax resident, because only in this case the personal income tax rate of 19% in both cases would apply. And consequently, also these effective tax burdens indicated here, and here are calculated based on the assumption that the owner is a Polish tax resident. In case the owner would not be a Polish tax resident, these effective tax burdens would most probably be different due to the fact that the personal income tax rate would not be 19%, but there will be a personal income tax rate applicable according to the legislation of the country of tax residence of the owner. Having in mind the facts that I've just presented, application of the so-called Estonian or lump sum corporate income tax model may give you two advantages. The first advantage is the fact that thanks to using the Estonian, the lump sum corporate income tax settlement, you are able to defer the moment at which the corporate income tax is payable. Because when you are paying corporate income tax in the classical model, you always have to pay corporate income tax, irrespectively of the fact if you are paying a dividend out to you as the owner or not. And within the Estonian lump sum corporate income tax model, your company is obliged to pay corporate income tax first when the dividend is paid to the owner. So in case there is no dividend payment, no corporate income tax is due. The second advantage is that the effective tax burden, namely corporate income tax and personal income tax combined, is lower in the Estonian, or also known as lump sum corporate income tax settlement, by 6.29%. In case the company is a smaller taxable person with revenues lower than 2 million euros yearly, or the effective tax burden is lower by 9.39% in case the company paying corporate income tax is a bigger company for which the higher corporate income tax rate applies. Estonian corporate income tax is not for everyone. It's unfortunately not just about ticking a box in a form that changes everything, but there have to be several conditions met in order to choose this model. And the, in my opinion, most important ones, but not all of them, are the following. First of all, the shareholders of such company, which is applying this Estonian corporate income tax model, can only be natural persons. So in case the company has shareholders which are other companies, the settlement via the Estonian corporate income tax model is not possible. Also, the company that is intending to apply this model of taxation cannot have shares in other companies, in other limited liability companies or joint stock companies or also partnerships. Then there's also the condition regarding the revenue composition. Namely, less than 50% of revenues of such company can come from passive sources. Things like interest, royalties, receivables trading, or related party transactions that do not add real economical value. Then there's also the condition regarding the employment. The company that is intending to use the Estonian corporate income tax model has to employ at least 3 persons which are not shareholders based on employment contracts for at least 300 days in the tax year. Or alternatively, this company may also spend an equivalent amount on non-employment contracts for at least 3 non-shareholder individuals. With respect to this condition, new companies get a grace period in their first 2 years. What is also important is that your company is allowed to choose the Estonian corporate income tax settlement for a period of 4 tax years. And consequently, all of the conditions enabling for this model of corporate income tax settlement should be met during the whole period of those 4 tax years. If you went through all of these conditions with your tax advisor and you came to the conclusion that your company is allowed to use the corporate income tax settlement according to the Estonian model, and maybe you've already also choose this model, you might think to yourself that since there will be no, as I've just mentioned, since there will be no dividend payment, there will be no corporate income tax. So you might potentially think as the owner that you might transfer some cash from the company to you, not in form of a dividend, and still no corporate income tax or personal income tax would be triggered. But this assumption is wrong. What you have to watch out for is that within the Estonian corporate income tax settlement, also the so-called institution of hidden profits was introduced. It foresees, exactly in order to prevent such situations where no dividend is being paid out, but still some payments are done to the owner based on other titles, that not only dividends are subject to Estonian corporate income tax. Those mentioned hidden profits that are also subject to corporate income tax within the Estonian corporate income tax settlement regime may potentially cover a lot of payments that are being done from the company to the shareholder, which are not dividend payments. These may, for example, be payments of remuneration to the shareholder based on an employment agreement if the amount of these payments exceeds a threshold defined in the corporate income tax provisions. As hidden profits may be also treated a loan granted by the company to the shareholder, or also a company car used for shareholders' private trips. And in such case, the company has to recognize as hidden profits the half of the car related expenses. And then once the amount of the so-called hidden profit is calculated, the applicable corporate income tax of 10 or 20% applies, depending on how big the company is. With respect to hidden profits, the logic is straightforward. If you are pulling the value out of the company informally, the tax office treats it the same as if you would declare a dividend. So who should be actually looking at this? The Estonian corporate income tax model suits, from my point of view, first of all companies that are having some kind of operating activity. they are selling services, manufacturing goods, or trading goods. It also tends to suit companies that are growing and reinvesting. So the profit is going back into headcount, equipment, inventory, or expansion rather than out to shareholders every year. It suits owner-run companies that already meet or can realistically build toward the employment condition. And it suits owners who are comfortable planning distributions deliberately rather than needing to draw cash out of the business constantly. And because of the 4-year commitment, which from my point of view is the biggest downside of the whole system, because you have to commit for 4 years, not only 1 year, but for 4 years, it suits owners with a reasonably stable multi-year view of how the business will run, not a structure you are planning to unwind the next year. Okay, everyone, thanks for watching. I hope this video gave you some insights, some overview of how the Estonian corporate income tax model in Poland works, and I will see you in the next one.